Canada saw a much higher than expected jobs report this week, and that may ultimately put the Bank of Canada and their potential rate cut on hold. This is also altering forecasts on what might happen with your mortgage rates later this year. The city of Vancouver has recently initiated two policies that will increase home prices. But on the flip side, one of the very first building permits for a multiplex within Burnaby has been approved, and we have an update on the exact costs and time that are involved. You will likely be as surprised as the developer was. Plus, the latest arrears data is in, how much did it increase by, and how much can it potentially keep rising for the rest of 2025. Quite a few important updates and shifts in real estate this week. Let's explore them now. And real quick, just before we do, our group, we've just listed a truly magnificent property this week, and we have to share it with you because it's a stunning family home, and it is located along Vancouver's Golden Mile in Kitsilano. It's on West First Avenue, a beautiful street. It features ocean views and has over $1 million in recent renovations, including recessed lighting in the primary, which is probably one of the nicest I've seen, including the ensuite that comes with it. Please have a look for yourself. We created a custom website for it, 3262westfirst.com. That's 3262w1st.com. Have a look. We had to plug this one. It's beautiful and definitely worth a look. Now, let's dive into what is important this week in housing, especially in Vancouver. What moves the interest rate expectations more than anything else is the labor force survey, i.e. the jobs market, okay? And as mentioned last week, Canada posted one of the single largest increases in new jobs for any month dating back 2 years. 91,000 new positions were created just last month, blowing past the expectations of 25,000. Thing is, 58,000 of those are actually full-time, right? Full-time has a lot more weight than part-time jobs. And this pushed the employment rate in Canada up for the first time in 2 full years. Even the all-important FIRE, or FIRE group, saw a notable increase. That's the finance, insurance, and real estate industries. And the reason that group is important is because they are understandably more cyclical and interest rate sensitive industries. As interest rates go down, these industries are bolstered up, and now that's being shown in the data. Now, we all know, of course, that 1 month of interesting or outlying data does not make a trend. And the thing is, when we pull back the curtain, the jobs report, it all looks a little even more strange. 62,000 of those jobs were for people that were older than 55 years old, meaning essentially that the core age of the working cohort in Canada weren't picking up jobs. Also, 40,000 of those total increase were, of course, in the public sector, building on the 45,000 jobs in the public sector we saw the month before in November. So the bloated government grew another 2% in just the last 2 months alone. We have not seen that rate of growth within the government dating back to 2021. A strong jobs number puts the Bank of Canada in a tough position when it comes to their decision on whether or not to cut rates. On top of this, we are seeing oil futures, they're increasing to start off the year, which is it's an inflationary element, and it basically gives the BOC a reason to hold, or at least even prepare to start raising rates at some point should that continue. And the 5-year bond, well, that's up 30 bips so far this year, hitting as high as 3.3% just this week. Now, a lot can happen over the next couple of weeks prior to the Bank of Canada's announcement, but as of today, the chances of a rate cut are dramatically lower than they were when we started this year.
Yeah, I find it very interesting when the private sector is significantly underperforming the public sector. It speaks to volumes, I think, on a macro scale of what's happening to private investment in this country too. Having said that, let's look a little bit more at the economy here. And let's keep in mind that there are other factors that will play into the rate cutting decision as well. So Canada's household debt, the debt to service ratio here remains at an all-time high near about 15%. In fact, Canada's household debt to GDP ratio sits just above 100%. How does that compare to the US as an example? Well, the US is sitting at 72% by comparison. And what's more is the share of indebted borrowers behind on payments for at least 60 days in any credit category has shot almost straight up since mid 2021 to heights not seen since 2019. And we are entering the phase where approximately 50% of all mortgage holders across the country will be renewing in the next 2 years. This renewing would see an increase in their payments by about 35%. And for all those reasons, the BOC may lower rates on the January 29th announcement. And just as an example, if your property was, say, $5,000 a month that you were paying for and you renew at 37% higher, that means you're going to be looking at something like $6,700 a month. So that will have an impact going forward on the real estate market.
Understandably, a lot of focus on mortgages going into 2025. And with the aforementioned bond yields increasing, it essentially means that even after all the recent rate cuts, fixed rates have been effectively unchanged going back to September. While variable, of course, continues to drop. Fixed rates have been priced lower than variable dating back to early 2023, but now they've practically converged. They're almost the same rate today, whether you chose to go fixed or variable. So what do you do going forward? Well, markets today, even with all this new data, they're still pricing in about 75 bips of cuts in 2025 total. Okay, and so that means by the end of this year, maybe by October, that will bring the overnight rate to 2.5%. This would create a variable rate mortgage around 3.7. Okay, as of today, 3.7 might be as low as variable goes. Obviously, a lot of year to unfold here, but you kind of get where this segment is going. Now, fixed rates, that is almost the biggest unknown right now. Obviously, they have been resilient in the face of bond yields and have not really moved down much, but there is potential for that. So we're going to keep you updated. And again, of course, if you are looking at renewing this year, big decision, get a hold of your broker, or feel free, of course, to reach out to us and we can help share some ideas for your unique scenario and how to best benefit on this changing landscape.
Yeah, and let's touch on affordability because naturally those two kind of go together. There are some changes taking place to affordability within the city here, specifically to net zero homes. So there was a 19% bonus density granted to developers who were going to build a net zero home. But that program is coming to an end here in 2025. It was a 3-year pilot project. And, BC has then now stated that every new home by 2030 has to be a net zero home. The added cost to build to net zero standards won't result in any more additional square footage that can be sold. It will just result in overall higher building costs for smaller homes that will definitely be passed on to the buyer. And what's more is the ban on natural gas in new construction, which is kind of ludicrous, I think, in many ways. This is also adding and contributing to the overall rise in cost. The increased cost to heat homes via electricity is just one element of that. But let's go into the multiplex just for an example here. So a new fourplex could easily be heated with natural gas, in fact, efficiently, very efficiently. However, if you now require electricity or a net zero, that means you're going to remove that and you're going to add in what's called a PMT. That PMT is a pad-mounted transformer. And with gas now banned, a builder is going to have to install a PMT, which costs around $150,000 and adds all kinds of setbacks to your development, right? It'll also add a dramatic amount of time because now you have to deal with BC Hydro and the time it takes for them to come and implement a PMT. It'll also take away from your parking stalls. I mean, let's be honest, the vast majority of homes that'll be redeveloped, we're looking at between 4,000 and 6,000 square foot lots. If you add in a 12 by 12 PMT right where you would have parking stalls, you're not going to have any room for parking. And so this means that, the buyers of a fourplex unit have just seen the price increase by about 40 grand on each unit. That's 3% higher on average. This is a government policy that does the opposite of helping create affordability. Remember, it's important that we measure what they say versus what they're going to do. We've been, I think, through 9 years of a lot of being told what's going to happen and not a lot of actually what's happening, right? So we have to hold their feet to the fire with this. It will not help create more affordable homes, and it will not help the parking situation in Vancouver, which is already getting dramatically worse. But then there are policies that are put in place, 2 more in recent months, that have a direct impact on the increase on prices of homes, right? So they claim they want to build affordable homes, but everything they're doing is leading to more expensive homes.
So let's stay on Multiplex for a minute here, because we have quite a significant update for the Burnaby area and for Multiplex. One of the first building permits for Multiplex in Burnaby has just been issued, and I was just given the breakdown on it this morning. So this is as hot off the press as it can be. If you know or don't know, Burnaby has already removed the requirement of a development permit. And even those can take half a year to obtain. So that's gone, right? So they already fast-tracked that element. This building permit for Multiplex from application to today took 4.5 months. So much, much quicker, far more expedited than what would happen historically, previously, and definitely in other jurisdictions right now. So from day one at City Hall to your ability to break ground, 4.5 months. But what about the fees? Right, everyone's curious, and there's a lot of speculation about fees and what they're actually going to be. Well, here's a hard example of the first BP that's been issued. The DCCs, the ACCs, and the building permit fees all in came out to $75,000 per door. Okay, there's been talks of $100,000. There's been talks of even more, but the first one has been issued at what came to $75K per door. But there's a bigger item or bigger aspect at play here. Offsites, right? If you've built anything, you understand that offsites can be a large part of your pro forma. In fact, most developers and builders that are approaching Multiplex in most areas, they're budgeting upwards of $200,000 to $300,000 for their offsites, right? That's to improve on the existing infrastructure, sewer lines, water lines, downstream upgrades, and so forth. In Burnaby, they have decided that the DCCs that you are paying cover those. Your infrastructure upgrades are covered by the DCCs. This is big news. So the offsites that are still the responsibility of this builder are going to be things like your new curb and gutter, upgrading the sidewalk, street lights, and landscaped trees. So for this fourplex, the total offsite costs came to only $60,000. I say only because obviously that's a lot less than 200. It's a lot less than 300. Okay. Needless to say, this developer is very happy with this update, and they are obviously 100% moving ahead with their project. They are now going to be building 4 homes. They're bringing homes to market, and the project is now more viable, which means, hey, maybe they might be able to do a second, a third, a fourth project here because their expenses are less than they originally budgeted for. So overall, finally, some good news in the development world. You're welcome.
Yeah, rarely do we get surprises to the upside. So it's good news. Let's talk on arrears a little bit here. It'll be a story for us to follow through a lot of 25 and 26 here. The latest mortgage arrears data is out, and it has risen very slightly, but it's risen from 0.2 to 0.21%. Why this is important is this is the highest since April of 2021. Though still below the pre-pandemic levels of 0.25. The 3 highest priced home provinces, BC, Ontario, and Quebec, they all maintain the lowest arrears rate at 0.17% each. There is a region that we are paying close attention to, though, and that is specifically to Toronto. The stories out of Toronto is that, condos, they're not selling with thousands of new units completing in the next 2 years. This will undoubtedly create negative price pressure. It'll push prices down in that area, and specifically to that property type as well. With many investors seeing rental rates continuing to drop, and those monthly losses are now amounting on average to about $700 a month. And that can be hard to keep up with. And, you can understand why, a portion of these owners would be behind on their mortgage payments. Toronto mortgage delinquency rates have just hit a 9-year high. It's not very good news for Toronto in this segment. Though don't let that headline distract you from the data, because when you look at the bigger picture, while the 9-year high obviously being problematic, Toronto's delinquency rate is lower than the provincial average at 0.16%. So people are making it work. It's just expensive, right? The area hit an all-time low in 2022, hitting only 0.06%. Money was a lot cheaper at that time. So while the arrears rate will absolutely climb in this area, it is nowhere near any kind of panic environment today.
So a lot of these condos, as you could imagine, are empty, right? They've just completed on them and they got to sell them. And so I was curious, like, what is the amount of homes in Vancouver listed for sale that are vacant? I'd actually never looked this number up before, and I did some research and I wanted to share this with you. Today, if you look at all the homes actively listed on the MLS, detached homes, 19% of them are sitting empty. And condos, townhomes, half duplexes, everything that falls under the attached category, 38% of those currently listed in GVRD are active. That equates to an average of 29% of all active homes currently listed being vacant. Okay, sounds interesting. I don't know if you consider that high, low. To me, it feels high. But I'm like, okay, well, I don't have a reference point. What happened in all of 2024 to see if it's increasing, decreasing? Where does it kind of sit, on the dot plot, if you will? So if we look at all the homes sold in 2024, detached was 20% vacant, so even a little bit higher. And attached was 35%. So a little bit lower, right? But basically washes out to almost the same at 28%. But then you have to ask yourself, okay, well, people build homes and they put them on the market, right? So obviously those are vacant, empty homes. And do you strip those out? How does that all work? Well, or at least how many are there? When you look at how many homes were brought to market and are vacant and they're brand new homes, it's 24%. So a quarter of the 28% of total vacant homes sold last year were brand new, vacant. But anyway, what to do with this data, right? I mean, were a lot of these with condos being such a high percentage, 35, 38% of condos being empty, were those past Airbnbs that people are now saying they can't afford because the long-term rentals just don't cover the expenses as much and they got to go to market with those? How many of these are secondary homes, vacation homes, and they're just now trying to avoid the vacancy tax? Just some fun data for you to have and use over dinner and create some good conversation there. But I think this is something that we'll track continually moving forward. Is how many homes in Vancouver are vacant and available to be purchased and moved into ASAP. Ryan, any follow-up thoughts on the amount of vacant homes in our city?
I'm interested to see sort of if there's kind of any correlation to that and jobs data or immigration data. I think those correlating could be an interesting sort of matchup. But overall, based on sort of the fluctuation between this year, last year, I don't see it being a particularly big issue at this point. Doesn't really surprise me. I do think a lot of those would be new homes, a lot of them. I mean, just in the area that we live in Mount Pleasant, there's a lot of, say, half duplexes that are currently for sale that have been built over the last 6 months that don't have anybody in them. So, that doesn't surprise me, but overall, it's not a worrying sort of subset of data for me.
Okay. Yeah, fair enough. And, let's be honest here. When a building completes, we often see a quarter of the units go to market, the week after it's completed. Look at Pure West, for example, right? I think there's something like 70 listings right now in that one tower that just completed. So that's fairly common and will obviously contribute to this type of ratio of vacant homes for sale. That is this week's episode. Thanks as always for tuning in. We will be here next week with a brand new episode. So you have a wonderful weekend and we'll see you then. Thanks.